My name is Alex Clark. I'm the research director at Asset Impact. So I've been involved with Asset Impact since its beginning as a research project with the 2 Degrees Investing Initiative, which at the time was a Franco-German think tank. And I've watched our journey from a small outfit of 2 or 3 people to the team of about 25 to 30 people we are today. And from the start, we focused on a fairly simple problem, which is the lack of visibility that financial institutions have into which assets in the real economy are responsible for carbon and greenhouse gas emissions and who owns them. So the incompleteness and the inconsistency of corporate reporting makes it very difficult for banks, investors, and so on to accurately assess climate risks and align their lending and investment decisions with climate goals.
So how does that work when we talk about sort of measuring these things? How does that work in practice?
Well, the very short answer is by using a concept that we pioneered called asset-based company data. So I'll just quickly explain what I mean by that. In this context, unlike the term asset being used in the financial context in general, we're not talking about things like stocks or bonds or other such instruments. We're talking about physical things in the real economy. So we focus our effort on the tangible things that are most responsible for emitting greenhouse gases, which, as we know, is the primary driver of climate change. And the premise that we operate on is that the transitioning of those assets or the activities that they represent to zero emissions equivalents is what's required fundamentally over the coming years to address the climate threat. So our approach involves identifying these physical things, linking them to their corporate owners, and then ultimately to the financial securities in which institutions like banks invest. And that's mostly in the form of debt and equity instruments such as the aforementioned bonds, loans, and shares. And we do this by linking direct owners of physical assets all the way up the ownership chain to their parent companies and also to standard identifiers like legal entity identifiers, ISINs, NAICE codes, and so on. And so this means that for any of the 70,000 or so companies in our data set, we can link each one to the emissions generating assets across, at the moment, 11 real economy sectors that represent about 3/4 of global emissions.
I suppose that the obvious question as a result of all of that is how does asset-based data transform the way that financial institutions actually assess and manage their climate risk compared to, say, historical and traditional monitoring or assessment methods?
Yeah, absolutely. So I think just before answering that question directly, I'll just go into a little bit more detail about how this is done. So it's quite fiddly, it's quite technical, and it's probably why we're only one of the few companies still these days that do it. So we start out by looking at individual assets within sectors that are most responsible for greenhouse gas emissions. So primarily energy, industry, and transport value chains. So in these sectors, assets are things like coal or gas-fired power plants, wind farms, oil and gas wells, ships, planes, steel mills, and so on. So we find out where those assets are, what they are, and we gather information on capacity, location, age, and that sort of thing. And then we build an emissions model that turns the activity metrics, which in the case of a power station would be megawatt hours of electricity per year or tons of coal per year in a coal mine, into emissions. Then we identify the owners of those assets so you can attribute those emissions to their owners, and then to the companies those owners are in turn owned by and who ultimately receive investment or funding from a financial institution. So you follow the breadcrumbs all the way from the physical things to the financial system. And by doing that, you can understand in a specific way where the emissions that underlie portfolios come from. So to come to your question, when you're designing and managing a long-term climate strategy from a financial institution's standpoint, the struggle that most of them still have and have had for a long time is assembling internally consistent, comparable, complete data on the climate performance of companies they lend to and invest in. And this also increasingly applies to how to assess the credibility of those companies' transition plans. And climate disclosures in annual reports and ESG reports and so on are known to be patchy and inconsistent. And that's changing thanks to tightening regulation, but it's happening slowly and perhaps even slowing down further, as we found out this week with the slight relaxation in the EU rules with the EU Omnibus. But ultimately, the data problem is really not changing quickly enough to give financial analysts access to the information they need to make decisions and ultimately separate higher and lower risk investments in the short term. And that's where asset-based data can really change things. So instead of extracting information from corporate reporting, which, as I already mentioned, suffers from consistency, lack of completeness, opacity, and so on. We start from the bottom up by identifying all these assets, recording or modeling their activity and emissions, and then mapping those indicators to companies. But what's crucial is that the way that we assemble the data allows it to be tested, validated, consolidated in a completely consistent way across all sectors and all companies. So the data is transparent, but it's also comparable across companies. It's internally consistent and it's global. So it's this completeness and consistency that's really essential for banks, investors, and so on that need to make apples to apples comparisons in assessing who to lend to, in what amounts, at what price, and for how long. And it's why the asset-based approach offers such a useful counterpoint to reported data that's usually presented in aggregate, usually using a slightly different aggregation methodology and set of assumptions for each company. The other problem is that this data is usually only reported at the parent company level. But our clients, particularly banks, but not exclusively, routinely lend to specific subsidiaries rather than parent companies. And to assess the climate risk or the competitiveness of those subsidiaries, they need to know which assets belong to which entity within potentially very complex corporate structure. So just to give an example, the climate profile of a large international company such as Enel, the Italian firm, would differ very sharply from that of its renewables-only subsidiaries in Colombia, Brazil, or Panama. And in each case, the assets and emissions tied to the subsidiaries present a very different picture to that of the group as a whole. And that's where the opacity and inconsistency in reporting hits a wall, and where the asset-based approach helps to unlock a much more in-depth understanding of how a company is positioned versus the transition. So the last thing I'd say on this is that the most important piece of the transition risk puzzle at the moment is on projecting a company's performance forward in time. So we've been thinking about this a lot and recently launched a scenario analysis product that compares the projected emissions performance of the companies in our data against the three major International Energy Agency or IEA scenarios. Very soon we'll be adding an additional comparison to the company's own targets, which will show the gap between where a company says it will be and what it's currently on track to do. And we're actively working to integrate NGFS scenarios too, which allows our users to see at a granular level how consistent the company's asset-based performance compares to its own aspirations and against external benchmark scenarios.
It's all very complicated, isn't it? And given the sort of tangled nature of the web of third, fourth, nth party supply chains that a lot of these subsidiaries are kind of operating with, that presents real challenges in how banks and financial institutions, investment companies, whatever, facing integrating the data into risk management frameworks. So how do they overcome those challenges?
Well, I think it's important to be humble from the outset and say that while asset-based data can offer a much richer picture of the transition risk facing a company than corporate reporting on its own, it's also true that financial decision-making is very complicated and often very sophisticated. So we're providing part of an investment story that's actually constructed using hundreds of data points covering politics, macroeconomics, local conditions, currency risk, and everything else. But as any management consultant will tell you, the first step towards managing anything is measuring it. So using asset-based data, it's possible to track much more carefully and precisely the emissions, but also the technologies and the associated risks, which are what really matter in finance, that are linked to a particular portfolio of assets or a loan book. So one of the fundamental starting points for us is that not all emissions are created equal. And it's very important for investors to distinguish between emissions that are under a company's direct control and those that are contingent on specific investments or on technological breakthroughs that are not entirely within a company's control. And it's also quite normal, by the way, to see asset-based company data disagree with companies' own disclosures. And sometimes the reason for this is innocuous. It's due to differences in boundary conditions or in how subsidiaries are consolidated. But in other cases, we actually find material differences between what a company discloses and our assessment that actually sheds light on the elements of companies' transition strategies that are not completely clear in their disclosures and have financial implications. But it's still a real challenge for financial institutions to deal with. So just to give an illustration, if we stick with the electricity sector, asset-based data will tell you not just what a given power company's total emissions are, but also how this breaks down by emission scope, by location, by generation technology. So two power companies with the same emissions can actually have completely different outlooks. So let's say one has an aging coal fleet that's reaching retirement age, but they also have a well-established and growing renewables business to replace it, while another one might have made recent investments in brand new gas-fired power stations that still have 30 years to run. So they might have the same emissions today, more or less, but they're completely different technology stacks. And without asset-based data, it's actually quite difficult to make this sort of direct comparison and understand why one would be potentially more or less risky than the other. From, let's say, a bank's point of view, let's say that you've got to this point, you're measuring the emissions underlying your portfolio, but there is still a bit of a question mark about how this integrates into risk management frameworks. So we've seen a few different examples from our clients. One challenge that they find is managing a very wide range of constantly changing regulatory risks. And this is very difficult, especially given that there are many industries like steel and cement, for example, that can't transition without significant capital or transition finance, but which also face major risks to their business as a result. But the better you know the emissions and technologies you're exposed to, the better placed you are to manage those exposures in the face of this uncertainty and these regulatory changes that are ongoing at the moment that affect the real economy. And these are things like the current turmoil, but also well-established and long-lasting policies like coal phase-out, carbon pricing, taxonomy alignment requirements, national targets, electrification, internal combustion engine bans, and so on, as we're already seeing in Europe and the UK and also further afield. Another challenge, but also an opportunity in integrating asset level data, is prioritizing engagement targets. So banks, asset managers, asset owners sometimes as well, have very limited bandwidth, and they need to use it appropriately in identifying which companies to engage with in a portfolio that may encompass thousands, in annual general meetings or in direct exchanges with the C-suite, for example. And with more detailed data comes a much greater number of stories to tell and questions to ask. It also helps to differentiate companies facing huge obstacles to successfully transitioning their businesses to net zero from companies that have a really robust and credible plan in place. And in turn, this helps to find the companies that it makes most sense to engage with on the detail of their transition plans. So this doesn't resolve the underlying challenge, is that there are far too many companies to engage with and not enough time to engage with them all. But we've heard from some of our clients, such as ING, that using asset-based data can help really refine and articulate that target list and to flesh out the subject matter much more than would be possible otherwise. The last challenge that we work very closely with our clients on is data provenance and quality. So to have confidence in using any kind of data from a third party for decision making, it's not enough just to have the data. It's equally important to know where it comes from, what quality checks have been run on it, and what, in our case at least, are the methodologies applied at each stage to generate the outputs. So we've had a robust quality assurance process in place since we began. And we also make improvements to our data sourcing and models quite regularly. We make the details of these models and our changes available to our clients. And at the moment, based on direct feedback, we're also working to issue a standardized data quality score that's based on the PCAF guidance to help our clients quickly understand what lies behind each data point in a standardized fashion, because that's very important to them.
Okay, so all that being the case, and you mentioned ING there, do you have any real world examples of how this data has influenced investments or lending decisions to mitigate climate related financial risks from among your client base?
It's a difficult question because it's very rarely the case that a single data point or a single source is the difference between a deal happening or not. And even when that does happen, we don't have full visibility of the process, since these decisions, are all confidential. But what we do know is that some of our clients are using our asset-based data as a primary source when they're assessing the transition profile of a counterparty or an investment target, because they trust our data ahead of the company's disclosures. Now, obviously, they look closely at disclosures as well, but our data is the primary source because of its completeness and its comparability and consistency. We also know that our data is being used by bankers as part of the front desk deal-making process, not just for ESG reporting. So we know specific cases where emissions intensity data, for example, is being tracked and used by banking clients in deciding whether or not to keep lending to firms in the steel and cement sectors based on how their performance was changing over time. A number of international clients that include Barclays, ING, it's already been mentioned, BBVA in Spain, and TD Bank in Canada have also been using our data for target setting and tracking across multiple sectors for quite some time now, which does have an indirect effect on investments as banks focus on meeting their targets, although it's difficult to pinpoint exactly where, of course. So Barclays does this with its Blue Track platform, ING with its Terra approach, and more recently, Morgan Stanley in the US has been using our data in setting physical carbon intensity targets for the automotive sector. We also find our asset-based data being used to separate the highest and lowest performing companies within sector allocations underlying portfolios, which is typically then used as a screen for removing laggards or the higher risk low performers, and potentially on the other end increasing exposures to the leaders or the best performers. And as I've mentioned, the same process can be used to generate short lists of targets to engage with, and an increasing number of our clients actually also have policies in place that preclude lending to specific sectors or technologies, which could be things like coal mining and unconventional oil extraction, for instance. So they can use our data to help enforce these policies by screening out companies involved in those activities.
We know that obviously that sort of innovation, which lots of companies are looking for in order to do business differently, we know that that brings compliance risk. We know that the regulatory environment is changing very quickly. So with all of those pressures evolving, particularly around climate risk disclosure, how can financial institutions leverage asset-based data to enhance their own compliance and reporting processes?
Well, I'm glad you asked that, because the regulatory use case is actually more often than not the starting point for most of our clients when it comes to starting to explore asset-based data. So as we already know, there are significant limitations to using reported data points alone, whether they're mandated by law or not. In general, they're not complete, they're not granular enough to support detailed analysis, and they only cover a fraction of the universe of investable companies, typically listed companies that have to report by law or as a requirement of being listed on a stock exchange. And by contrast, asset-based data is agnostic in the sense that it attributes activities and emissions to any company as long as it owns assets. So in the banking sector and for asset managers, it's more in the alternatives allocations. There do tend to be exposures to companies that don't report directly. And that's either because they're not listed, they're not required to disclose, or they're subsidiaries of disclosing companies that are not covered by the full suite of regulations or rules. So asset-based data helps to fill those gaps by attributing assets and emissions to those different entities within fairly complex corporate ownership trees that are a reality in most cases for large international companies with multiple subsidiaries. So this is very, very helpful, our clients find, for reporting purposes, and it helps to calculate indicators like financed emissions for voluntary frameworks like PCAF, the Net Zero Banking Alliance, the Science-Based Targets Initiative, and so on. And with the regulatory environment undergoing all sorts of changes, it's also helpful for disclosing for compliance purposes, though. So for our banking clients in Europe, the EBA Pillar 3 ESG regulations are one of the most prominent examples, since they encourage granular emissions measurement and estimation, and they allocate exposures to the EU taxonomy categories, which our data can help to support with the help of NACE code classifications. So late last year, we actually published a 3-part explainer series on EBA Pillar 3 and how our data can support banks regulated by it, which is available on our website. And we'll also be publishing a more detailed practical guide to using our asset-based data for EBA Pillar 3 reporting in the next couple of months. Now, interestingly enough, we've also seen the regulators themselves using our data to assess and manage transition risks sitting on banking books. The European Central Bank, for example, published a report last year applying the PACTA methodology, which relies on our data and was established by our founding shareholder, the 2 Degrees Investing Initiative, before it was transferred over to the Rocky Mountain Institute, or RMI, to test the Paris alignment of banks under its supervision. And the year before, the California Department of Insurance led a detailed study of the transition risks underlying insurance companies' portfolios in the Western US, also in collaboration with our partners at RMI. And these are very interesting cases of the regulators using an asset-based approach, because it does provide this useful independent check against what companies themselves disclose.
So given all of this activity, and it's becoming more disparate, more diverse as companies evolve and the landscape, the investment landscape evolves, given all of that, how do you see asset-based data analytics shaping the way financial institutions manage their climate risk strategies and their frameworks in the future?
Well, it's probably fair to say that at this particular moment, the ESG world appears to be somewhat all over the place. And that's partly, but it's not entirely, because of the Trump presidency and the rather cavalier approach of the current administration. And there are certainly areas where ESG as a concept, and climate as well, to a certain extent, is going through a really turbulent period. And it's not clear entirely what the result will be. But I think growth in the use of asset-based data will continue. I'll get onto why in just a second. But it's also worth mentioning the other major disruptor beyond politics, which is the astonishingly fast pace of artificial intelligence, which makes it much, much easier, much faster to collect and process and structure publicly available information, which includes corporate ESG reports. So a few years ago, if you were a bank, you would have needed entire teams of people to collect corporate reported data every year. But now you can have a machine do it for you much more quickly and probably more accurately as well. But asset-based data is a bit different, not least because in our cases it focuses specifically on climate transition and physical risks, which are here to stay and very real to investors, much more so than ESG in general. And no matter what a particular administration says or does, as JP Morgan said actually recently in a report on climate, the material risks from climate change are not going anywhere. So one of the reasons that asset-based data is going to continue to be important irrespective of the pace of artificial intelligence development is that collecting and validating information on individual assets and creating those links to corporate owners is not a trivial task. It's certainly one that the advancements in AI can accelerate and improve, and we're embracing that to allow us to focus more of our time on expanding into new sectors and building new analytical models. But fundamentally, the value of asset-based data in offering not just transparency, but the ability to really understand the risks that underlie portfolios is here to stay. And all of the use cases that we've already talked about will continue to consolidate and embed themselves probably for years to come. There's still a lot of basic work to do in fully integrating climate into formal risk management frameworks and using company level, asset level signals and so on to accurately price risks. That's clear. And it's also unfortunately still the case that many investors still see transition risks as more of a reporting compliance problem than a risk problem. But on the bright side, where we see the most potential for movement on this point is in two areas. One of them is assessing the viability and the credibility of transition plans, as we've already talked about. And the reason for this is that many large companies have had targets and mission statements and so on in place for years now around climate. And it's an interesting time because we're starting to see which ones are serious about their pledges and which ones are not. And testing this credibility by comparing our projections with company targets and external scenarios and so on is a really exciting area we're actively exploring at the moment. The second area for further applications is using our underlying data, which is effectively a dictionary of what exists and where it is and who owns it, to create a properly holistic climate and nature assessment of a company's assets by mapping transition, physical, nature, potentially even societal risks together and tying them all together in one place. So by working with other parties to assess location-specific physical risks that are tied to assets and ultimately companies, our data can also be used by specialists in these arenas, whether it's physical risk or nature or biodiversity, etc. And that includes, in some cases, our clients' own in-house physical risk teams, but also other companies that specialize in these topics. And together we can really help to build a comprehensive picture of the risks and the opportunities that companies face, ranging from their ability to pull specific decarbonization levers, which is what we focus on, to the robustness of their flood and drought defense plans. So I think the ultimate goal that we're working towards is a world in which data like this is being used as standard in financial modeling of climate and financial risk, and it's fully embedded into risk departments at financial institutions. And just to be clear, we're a very long way from that. But there's a real constellation of potential applications of asset-based data out there, and I think we're still really only scratching the surface.
Well, whatever is going on around the sort of the periphery of all of this, there's absolutely no doubt that it's a fascinating space to be in. Almost like there's something Dan Brownish about sort of unpicking the layers and the puzzles that sit behind organisations as they kind of consider investment opportunities and portfolios. Alex Clark, thank you very much. It's been a fascinating discussion. You work in a fascinating part of risk and investment, and we wish you well. Thank you.